Hi, good evening, everybody. We will be getting started shortly, just another minute or two, give everybody some opportunity to jump on in and we'll get started. All right, so the time is now 7:04. We'll get started now. Um, I want to welcome everybody. Thank you for taking the time and joining us on this webinar today on a Thursday evening. On behalf of Terra Equity Group, I would like to welcome everybody on our webinar about investing strategies, combating inflation and a recession, right? So we will touch upon all these topics as we progress through the webinar and talk about market trends that are prevalent right now as we navigate towards these times. So we'll get started. First and foremost, a little disclaimer about making sure, what we talk about here does not indicate or, it's just projections, it's forward-looking statements. And certainly consult your financial advisor or fiduciary or your CPA and what have you before you get involved with investments. So a little bit of financial disclaimer here as well, and a little background on Terra Equity Group and who we are, about us. So the company was started with Vino, our CEO, who's also on the webinar, along with, I'm joined by Karan and Viraj, who will also be presenting alongside me. So we've been in commercial real estate for about 12 plus years. And right now we have assets which are close to 4,000 units that we're owning and managing. Currently a little shy of 300 million in assets under management. Our hallmark and the guiding principles that we follow are capital preservation being one of the big ones, value creation as well. We certainly finding off-market multifamily assets, and we curate, believe in long-term relationships with brokers, investors, and so certainly in this investing environment or real estate is a small world, and certainly having good relationship goes a long way. And we also invest in emerging markets, and we'll touch upon a lot of these points as we go through our presentation today and the webinar. So moving along, our values are family, passion, and legacy are the hallmark of what we do here at Terra Equity Group, and we certainly live and die by these as we progress on and as we get into projects and the relationships and what we create here at Terra Equity Group. So moving along, our team here, obviously I mentioned Vino, our CEO and founder, who has accounting background and has an extensive experience in real estate, dating back to almost 25 years or above that, who we are also fortunate enough to have Stephanie Walter, who is the owner and founder of ERB Wealth. She's also one of our partners alongside me as well. And a lot of the supporting cast that we have here in our back-end office in Fort Lauderdale that make and shape everything that we bring to the table and we carry out as a firm and as a group here. So certainly a little bit more about us and our backgrounds. I'm not going to bore you with a lot of the details, but we'll get moving. All right, a little bit about a recent win. So on the past 24 months, we've been super aggressive, especially as COVID hit. We saw a lot of uncertainty in the market, and we took advantage of that as sellers were kind of on the fence, or owners were very skeptical as to what would happen, and we were able to pick up some great assets that are doing phenomenally well. As you can see, some some of these, so some of these assets are certainly um, doing tremendously well, and are well beyond our projected returns that we had projected for 2-3 years down the road. We're already hitting those numbers as we speak in the current market that we're in. So we'll move along to um, another slide on the recent wins. These are some of the acquisitions that date back to 2019 and 2020 in that sequence, and certainly will show you the projected returns that are certainly well above 20%. We're averaging those, and in many cases, we have already or have started to hit those numbers as we have been in these deals for a very short time. Some of these have been, like I said, dating back just to 2019, not even 3 years. These four properties, or three rather, highlight our wins for this year. The Terra Hill Estates, which is in Winter Haven, 76 units that we closed in March. We also have a Terra Villa Park, which is in Winter Springs, Florida, which we closed back in February. And then we have more recently our Silver Star portfolio in the heart of Orlando. We'll be touching a little bit deeper into this project, which is the only current project that we have available. So we'll get into that a little bit later into the presentation, or the webinar rather. So the current market trends, as we see, there's a lot of uncertainty in the market. Volatility certainly is at the helm of what we're dealing with. As you can see, the inflation that we have seen is a record high in the last 40 years, right? Now, it peaked off in June, and as we see July, there was a little bit of a break where it actually went down, but that's certainly not an indicator of what the trend is going to be. Certainly dependent on various factors that would implicate, but for now we are somewhat on a little downward trend, but it would be interesting to see how August fares out. As we can see, the 8.5% increase is certainly the highest since 1981, and if you're looking at it, it certainly broke all records when you compare to the history and what we have seen in the coming years. And so with that being said, we will touch upon the recession aspect of it. We did have 2 quarters where the GDP actually went down, and as a consequence, we are technically in a recession, as we could see based on the GDP. So certainly the country is headed towards a recessionary trajectory, and we'll touch upon how that impacts and what we do here at Terra Equity Group, and how our investments are going to be impacted by that. And that's certainly the essence of this webinar. We want to make sure you're well aware of what we're doing to combat a lot of this, and how your money could be in a very safe and secure investment vehicle that can continue to grow and continue to outperform certainly these challenging and difficult times. So the interest rates, as along with the inflation and what have you, has been constantly rising as per Freddie Mac, and this currently shows how we are headed. The interest rates peaked in June to an all-time high. They have somewhat come down since then, but however, in August, you can see that this data goes back all the way to, or as recent as August 8th. We're starting to see a little bit of an uptick as well. And I believe that was a time when we did have an increase in the Fed rate by about 75 basis points that we recently saw. So again, very telling and indicative of how the interest rates are headed, and what that entails for us. We will discuss and how that impacts us, certainly, in the webinar as we progress, and what we're doing to combat that, and we'll touch upon that as well. Now, off relief, you may find the 10-year treasury yield, right? That is what certainly, so a lot of people get confused when, and you can correct me if I'm wrong, but everybody in the residential real estate market, yes, your interest rates are tied to what the Fed is doing and how much they're increasing and what's happening there, right? For the commercial market, we go by what's called a 10-year treasury yield, right? So in essence, that again also peaked in July, kind of in congruency with what the interest rates were. As I highlighted before, that June was the peak of that. But for the 10-year treasury yield, as we look at it now, that actually went down in July, contrary to the Fed hike that we saw in the interest rate. So from that perspective and what we're looking at, we are seeing that it's a little bit of a relief for us in the commercial market. And that's certainly the rates that we kind of go by, or what impacts us directly when we're in this volatile market. Do you want to add on that a little bit? I know you have certainly more experience than I do on that, and in terms of the
yeah, the interest rate is basically for us is the 10-year treasury, and then on the top of that they add some basis point depending on the lender and what they're doing, but they don't increase like the home rates are like 5.5, or sometimes they touch 6, but here we're still between like 4.65 and close to 5, depending on the property location and the credit worthiness of the buyer. So that's what they look at it, but it doesn't go as high as everybody thinks that is going to reach. So far we still getting 4.65 or 4.8, in that range.
Perfect. So we'll get going here, and I will now turn it over to Karan, who can talk about combating inflation through multifamily investing and how we can fare in these times.
All right, everyone, I'm going to just touch base on how the rental markets are faring in this, trying times. I know it's difficult for everyone. Inflation is high, interest rates are starting to get high as well. The difference kicks in really for apartment buildings. The biggest thing is that there's very few apartment buildings that are being built. As you can see the numbers on your screen, there's 14 renters competing for apartments. So the supply is unable to keep up with the demand right now. So that's kind of what's pushing rent increases, and that's something that we're seeing across almost all of our properties. That's what we're seeing in different markets as well. Interest rates aren't really going to affect the rent prices as much as one might assume, just because the supply is just out of this world right now, or the demand is out of this world right now. The supply has no shot of keeping up with it. Another thing that we're seeing is that as interest rates continue to go up, as inflation continues to happen, we're not sure if that will happen, but if those trends do continue, more individuals are going to hold off on purchasing homes because financially it doesn't make sense for them to get into those high interest rate situations, and instead they're going to be pushed towards renting apartments. So what's going to happen then is that's going to further the demand for apartment growth. So please, we can go to the next slide. And so this over here are some of the top markets, especially for rent in 2022. Being based out of South Florida, one thing that we're really seeing, and we're seeing every day, is just the number of people that are moving in to the Miami-Dade County area. Population growth is a huge projector, or it really influences rental growth as well. Obviously, the more people you have moving in, the higher the rent growth. And as you can see, 3 of the top 4 rental markets are based out of Florida. 5 of the top 20 are in Florida as well. That's driven primarily by population growth. Go to the next slide. So if we look, this is another study that's showing kind of the year-over-year rent change that we're seeing. And these rental growths are kind of unprecedented in the sense that, if you look at the Orlando market, we're looking at around 35% rental increases year over year. That type of growth really bodes well for, multifamily apartment complex owners. But just in general, rental increases have been occurring at a very high rate. And then next slide. So now we're going to get into kind of investing in multifamily real estate, kind of how that works for us, why we think it's the ideal option. The biggest thing is passive income. When you invest in multifamily real estate, especially if you're investing as a limited partner, it's essentially 100% passive. You don't have to worry about the day-to-day operations. You're not going to get calls in the middle of the night, talking about leaky plumbing or leaking toilets, things like that. So when we say passive, we mean 100% passive. The second is that, multifamily is a fantastic hedge against inflation. As you know, and as we're seeing, the dollar is being worth less and less every year. We've seen this time and time again. As inflation occurs, gas prices go up, groceries go up, and rent also increases. So that's another way why we think multifamily is a great hedge as opposed to traditional housing. In your normal homes, there's kind of the issue of interest rates, inflation, whether or not you're going to be able to find a buyer for a certain price. And apartment buildings, especially if you choose the right apartment building, you don't really have to worry about all of that, especially when you're in the right market. There's always going to be renters. There's a huge demand for them. There's not as much supply for it. And when that demand is there and there's that lack of supply, it really drives the rental increase up further than just the natural growth in rent that occurs. And then the last reason is that there's extraordinary tax benefits. Something completely unique among all investment classes is that real estate really offers the opportunity to have tax savings through depreciation and things like that. We can go to the next slide. So now, traditionally in multifamily investments, this is kind of the cycle that you see. You have a buyer's market. The buyer's market starts cooling off. You start going to a seller's market, and it peaks off over there, and it turns back over. And this is all dependent upon the vacancies. How when the vacancies increase, obviously it's a time where you can buy an apartment at a very attractive rate. When construction is slow, that's another time. When vacancies are declining, that's when that you're kind of hitting that peak of selling. But that's really more of the traditional market that we see. So if you go to the next slide, please. So this is kind of more of the trend that we're noticing across our properties. It's kind of like this upward W, upward U that's occurring. It's just that at this rate, more and more people are entering into the rental space. You have kids coming out of high school, going to college. You have college students entering the workforce. And then on the flip side, you have individuals who are traditionally renting. And, whereas in the past, there was a huge emphasis on buying your own home, it's kind of getting to that level. Nowadays, we're seeing more and more people prefer renting as opposed to buying a home. Especially now with the interest rates going so high, more and more people are going to hold off on that, which is why in the traditional market, you would say, oh, it might be a great time to look into selling, things like that. But right now, the way that trends have been for the last couple of years, it's that most people prefer renting. And the current situation is kind of indicating that more and more people are going to go towards that renting situation. So again, the constructions of new apartment buildings, new spaces to live, they just can't keep up with the demand that's going on, especially if you're in the right market. So now I'm going to hand it over to Rob, who's going to walk us through kind of one of our opportunities that we have.
So by now, next slide. Yeah. So by now, you're probably wondering what the opportunity is. The opportunity we're presenting today is the Silver Star portfolio, which consists of two beautiful properties. We have Highgate, which is 320 units built in 1990, and Collington, which is 216 units built in 1992. The construction should be noted that is a concrete block construction. This type of construction is preferred more and more in Florida because it's very resistant to hurricanes and it is largely resistant to mold. And now, as you see, we have this property located in prime Orlando in Florida, and Florida is an area where we stand out and shine. Our advantage in the Florida market is twofold. Number one, we're based in Florida and have lived here for the last 35 years. We have the ever desirable boots on ground, and we know all of the teams here, from management to construction to contractors, all different things. We know this specific market because we have acquired and run other apartment communities located in the Orlando area. Why is this important, you may ask? Well, we have property management in place and all the contractors like I mentioned, and it's very important for the phases that we have listed right there, as you can see on your screen. Phase one, we have the opportunity to increase rents to market level. We're gonna incorporate our proven management team, which will enhance the tenant retention and decrease our expenses across the board and provide superior service. Then we'll move into phase two, which will cause us to lease out to units to our outstanding tenants, give them renewals, and look for, our other tenants, have them look for a different place while we raise rents to market price. And the lease out efforts, like I mentioned, will include rebranding our signage and our advanced marketing metrics. Emphasis will be on bringing quality tenants in order to limit turnover and allow for steady rental increases. And our phase three, these efforts will include exterior updates, which is new paint, new lighting, fencing the perimeter, renovating the laundry room, and rebranding, basically giving our tenants a nice place, a place that they can brag about. Unit upgrades will consist of new flooring, kitchen, and bath enhancements, lighting and plumbing, similar to the proven upgrades that we've done elsewhere. A more attractive exterior and interior enhancements will definitely attract also a higher quality tenant, which will cause them to stay for a longer time if they truly enjoy where they're living. And yeah. Next slide, I'm going to pass this on to Vino, and he will go into the financial summary.
So let me tell you guys a little bit about what's in there for my investors and the people who wanted to invest in this property. We consistently projecting 25% annualized return on this property. The market ROI, monthly cash flow payment for at least 7% paid through holding, distributed monthly. Until the time of we are holding. We also only projecting 5% increase on the rental growth, even though we learned previous slides that the rent growth is about 35%, and we are getting more than 35% on these units, but we are only projecting 5%. Expense ratio that we are projecting here 3%. That's little lower, but based on our experience, we could able to achieve that goal. So far on this slide, about 25% annualized return and 7% on monthly distribution we're projecting for our investor. Next slide. Next slide. Now, here are our projections on these 2-bedroom, 3-bedroom, 1-bedroom, and 1-bath. When we took it over, it was rented for $1,200 and market rent was $1,370, another one $1,600. But just to point out, we already have pre-leased 3 bedrooms and we're charging $2,100, so way above what we projected at $1,600. Orlando market recently was out there in the data that they are 20,000 units short, and they're also not building fast enough to accommodate all the people are moving to Orlando area. Orlando is situated in the middle of Florida where people feel safe and a little bit hurricane proof because hurricane doesn't hit inland that much. So we are increasing rent. What we projected here in our projections, we're really very, very high, almost like $500 more than what we're projecting here. Next slide. Now let's talk about a little bit, returns. Like we said, in our past properties, in this one, we're projecting about 23, 25% return, annualized return on this property. I have seen in the market like S&P, for the very long time, they're averaging 8%. Even, Dow Jones Industrial Average's last 40 years return was average 6.5 share appreciation. Even the, Warren Buffett's company, Berkshire Hathaway, is just done 10% for last 20 years. So in this case, we are, within 3 to 5 years, we will be almost doubling our investors, capital. This one is, cash flow basis year by year. Now the last slide is equity returns and what they're selling. We bought it at a 4 or less than 4%, 4 cap. Even though we got it in a good basis, but the unit basis, we got it like close to 170,000. Right now, properties in Orlando market are going 250,000 per door. So our exit price is, we're very conservative in our exit price. Even achieving at 4.75 cap, this is we projecting worst case scenario, our returns is way, way high than market produces in any other places in the market. So our, investor get to enjoy with this property around or way above 25% annualized return, and we will be paying 7% monthly basis distribution. And the cash flow is already, we are, what we're projecting the cash flow is creating huge cash flow in within last couple of months that we have seen.
Vino, before we wrap up, I just wanted to kind of touch base on a few of the items I had hit earlier upon in regards to the inflation. And so I want to do like a quick Q&A before we open it up to the rest of the participants. So I wanted to ask you, where do you see, and certainly you have been part of 3 of these cycles or the downturns in our economy, with dating back all the way to the dot-com boom and bust in the 2008, 2009, and more recently now, COVID, which kickstarted this downward or recessionary trend in our economy. In terms of inflation, and you certainly had assets back then, where do you see us being aligned with this? How do we, how are we impacted, and what are the positives that you see coming out of this, especially in the multifamily asset class?
Well, we're a little bit impacted by the interest rate increase, but in our case, we got a really low basis on this property and we capped it off with the rate cap. So, we cannot go above 3.5%, doesn't matter where the market trends. And I don't see that interest rate continuously to go high up. I was reading a news the other day, the Fed is already, talking about not to increase too much. They talked in their last meeting, but we don't know where it goes. But especially with this property, we are like good at interest rate what we have. Never go above 3.5% and then increase. Now, I don't know how long that increase is going to last, but even if we're doing a 35% increase on the year 1 or year 2, we are well above our projections. And even if the market settles down, we can still, especially in Florida and especially looking at the nationwide where we are 5 million home shortage, our construction is not keeping up with our demand. We have every year 1.5 million new homes needed, or new units required. So we are not keeping up the pace with our growth, and that's where I believe that rent still easily be increased 5% annualized basis. But next couple of years, what I see in Orlando, that this year 35%, next year may not be 35, but it will be in the double digit session. So even the rent will offset the recession that we are talking about, and what we're earning for our investor. We see a bright future.
Okay, so even though the outlook and everything that you see, so everybody's talking about grim, and it's looking very bleak outside, but certainly for us, the projects that we have picked out, the markets that we are in, it bodes well based on your experience and how we're headed in the trajectory, even though it's in a downward trend for the economy. For us on the end, we're on the receiving end of it. We're going to benefit from a lot of this. That will certainly make real estate in this market and these type of assets and multifamily pretty much a home run or a slam dunk, if you would. And that's how you hedge against this inflationary time. If you were to have your money, let's say you had $100,000 saved in your bank account, based on 9%, which is what's reported. It's certainly, I believe, it's much higher than the inflation rate. This year, you would have probably end up with $90,000. You know, it's almost a 10% inflation rate. Now, had that money been invested in a real estate project or investment like this, you certainly would be taking advantage of the appreciation, the organic growth that has happened, the forced appreciation that we're seeing with all these rent bumps and rent increases that we're seeing, and the depreciation as well that you would have saved on the taxes. Do you want to talk and touch base a little bit, Vino, on the depreciation aspect of it and how the investors can benefit? Because I know that's a strategy we certainly use here at Terra Equity, which is the extra cherry on top or the gravy on top of these, you know, exciting returns that the investors can expect from us.
Yeah, the depreciation is not calculated here. Depreciation is basically we do cost segregation studies on our property, and we take a bonus depreciation on year one, where our investor on year one, they're able to get extra depreciation on their investment from anywhere from 30 to 35%. They've been able to save. Either they can, you know, write off against their income, or they can use when they make a capital gain on this one, they will write off. So this will be tax free. So, you know, the first year anywhere from 35 to, you know, 35% up to 35%.
Perfect. So that's in addition to what's the projected returns are on these projects. Now you may be asking, as I flip along to the next slide, how do you qualify for this? Well, certainly we would love to have a conversation with you if this does pique your interest and you feel that, hey, this might be the path that I want to take. We want to make sure you are the right fit and we're the right fit for you. And in order to do that, we'd have to get on a quick call and have to assess what your end goals are and needs are, and keeping in mind what you can expect from us. And we want to make sure we're a good match, because frankly speaking, if we're going to be part of an investment and be in a transaction for close to 3 years or maybe a little over, depending on how the market is, then we certainly want to make sure we're a good fit for each other. And we'll do that by, you know, jumping on a call and kind of assessing where you're at and where we're at and how we can provide synergies by working together. We have some FAQs here. They're pretty common. You can find these on our website. So I'm not going to dwell and spend too much time on these, but certainly has to do regarding the money. When can you invest? When can you get out? Regarding the SEC rules and what have you. So I'll leave this there, as a pitch deck is also available for you all to review at your leisure. Now, I believe we have a question regarding an example, and that particular, give me 1 second, let me pop that open here. So we do have a question regarding what can you anticipate and expect, let's say if you were to invest $100,000. So we have 2 tiers of investment. The first one is 100,000, and that particular tier you are looking at a preferred return of 7%, which is meaning you're getting $7,000 annually. We divide that up into 12 monthly payments, and you get a little less than $600 on a monthly basis. Now we have when you exit. So on this particular property, we're projecting a 23% annualized return. For easier math's sake, we'll do 25%. Let's say if we're in this project for a 3-year time period, so you got 25% each year, times that by 3, you're looking at a total return of $75,000 on top of your $100,000 that you had initially invested. Out of that $75,000, you have collected $7,000 each year for the past 3 years. So you have effectively collected $21,000 throughout the holding period. The remainder $54,000 It's given to you in equity. When we exit the property, it's what's also known as a waterfall that you will get. So that is typically what you can look at. Now, in addition to that, that depreciation that you're going to get, which is anywhere, like Vino said, I like to quote around 30%. It can be a few percentages over and low, just depending on the size of the project and the vintage. But if you keep that 30% benchmark on $100,000, you're getting $30,000 worth of write-off. If you're an active investor, you can certainly use that to offset your active income. If you're a passive, you can certainly carry that forward until you exit. Okay, so when you're exiting, you can certainly help you. That depreciation can offset the gains that you have had in the past 3 years with this particular investment. Vino, I'll kind of open it up to you. If I missed anything, if you want to clarify something or add something to that.
Vino, I think you might be muted.
Yeah. Okay. So based on the example, if they're active investors and they can write off that $30,000, that means $10,000 on the year one. That's 10% return on year one. That's not calculated here on the slide. So you covered basically everything in there.
So the cap rate, there's another question here. The 3.5% cap rate is, and the question is that a total rate or adjustment to the 10-year treasury? I think cap rate is more of an arbitrary number that we utilize to value the property. I don't know if you want to. I'm not sure if we understand.
No, I think their question, what I understood, they're asking, we are capped above the treasury. Okay. Yeah, that's the total cap. Our interest rate will never go above. Our actual rate is 2.1%. So and when we bought the rate cap, maximum that we will be paying to the 3%. Anything above, we start collecting back from the rate provider. So our interest will never increase more than 3.5% for next 3 years.
So that's our insurance against this volatile market and economic environment that we're in, certainly, to hedge against that risk and be protected should the market get any more crazy and the interest rates may go higher or the 10-year treasury goes higher, and then we'll certainly be protected with that. Any other questions? Let me see. All right, I don't see anything else that has come up. In the interest of time, we certainly want to thank you all for joining Terra Equity Group, and Vino, Viraj, and Karan, thank you for being my panelists and presenting on a certainly pertinent topic, which speaks volumes, certainly in the times that we're in. And we want to make sure everybody is aware of how real estate and particularly multifamily asset class can outperform in these times, and the leverages that we have and the experience Vino has garnered over these 25 years that we can use and utilize to navigate these rough times and the economic environment we're in. So our information is on there. Should you have any interest, feel free to email us or call us, and we'll love to get on a call with you and dig deeper into Silver Star portfolio and how we can make that work and make it a great investment for you. So with this, I will wrap it up. Thank you, everybody. Have a great evening. Thank you for joining us. Thank you.